$2.5 trillion. That's how much the global economy is pouring into artificial intelligence. Right now, this year, we're promised a revolution. The replacement of human labor. But what if the entire industry is the biggest bluff in human history? Today, we're going behind the curtain of the biggest tech race of the century. Over the past year, AI company valuations went through the roof. But behind the glossy keynotes, there's some terrifying math, trillion-dollar obligations, circular financing schemes, and a physical shortage of resources that no amount of money can fix overnight. Today, we break down exactly how this financial snake eats its own tail, and what happens when the bubble finally pops. Let's get into it. Let's take off the rose-colored glasses and look at what the numbers actually say. Out of that $2.5 trillion, more than half, roughly $1.3 trillion, isn't going into software, not into smarter algorithms, not even into ChatGPT subscriptions. All of that money is being poured into physical infrastructure, concrete for data centers, megawatts of electricity, silicon chips. What you're looking at is a textbook infrastructure bubble. Investors are building factories and server farms for a technology that still hasn't figured out how to turn a real profit at scale. And here's the part that should really keep you up at night. OpenAI has, at various points, announced infrastructure commitments reaching over $1 trillion, spread across multiple major vendors through the early 2030s. Even after later revisions, the scale remains staggering relative to the company's current revenue. So, how does a company that size plan to pay for commitments of this magnitude? Welcome to the world of the financial Ouroboros, the snake that eats its own tail. Wall Street's own analysts call these circular deals. Here's how it works. A tech giant like Microsoft invests billions into OpenAI, much of it not in cash, but in Azure cloud credits. OpenAI uses those credits to buy computing power from Microsoft. Oracle signs enormous cloud deals with OpenAI and uses that money to buy chips from Nvidia. And Nvidia invests tens of billions right back into OpenAI. The money never really leaves the circle. It just goes around inflating the paper valuations of these companies on the stock market. Morgan Stanley and other analysts have mapped this web. Their conclusion: nobody outside these companies really knows how much of this growth is real demand, and how much is just money being passed around in a circle. Investors see the reports, see billion-dollar revenues, and keep pouring in more money. But a real product, one that could actually pay back these trillions in the consumer market, still doesn't exist at the scale the spending assumes. And it would be one thing if this were just a financial pyramid. But this entire trillion-dollar AI empire physically depends on a handful of choke points on the map, so fragile it's almost absurd. Number one, the machines. A Dutch company called ASML is the only manufacturer on Earth of the EUV lithography machines. The massive machines without which it's physically impossible to print the most advanced processors. No ASML machines, no AI. Number two, the factories. Even with the blueprints and the machines, big tech still can't make the most advanced chips itself. Over 90% made of the world's leading-edge processors are baked on a single island, and TSMC's factories in Taiwan. Any serious escalation around that island, and Silicon Valley turns into a pumpkin overnight. Number three, the sand almost nobody talks about. Look at a tiny town in North Carolina called Spruce Pine. Up to 90% of the world's ultra-pure quartz is mined right there. Without that specific sand, you physically cannot make the crucibles used to grow the silicon crystals inside every chip. When Hurricane Helene flooded those mines in 2024, executives at Nvidia and Microsoft genuinely panicked. The entire global AI industry hung by a thread over some American dirt. And on top of all that, data centers already consume more electricity than many entire countries. We're building a virtual world that the physical planet doesn't yet have enough power or hardware to support. History moves in cycles. At the turn of the 2000s, the world went just as crazy over the internet. Companies with a .com in the name soared thousands of %, then collapsed, leaving investors with nothing. So does this look like the 2008 financial crisis? The Bank for International Settlements, and the institution that literally advises every central bank on Earth, says the scale and pace of the current AI investment boom bear a clear resemblance to earlier investment manias. And that's the scary part. Their 2026 annual report draws a direct line from today's AI boom to the .com crash, the railway mania of the 1840s, even the canal investment manias of the 1830s. Every one of them started with a real technological breakthrough that attracted more capital than it could ever pay back. But here's the part that should actually worry you. The BIS also warns that if this bubble bursts, the fallout could be highly disruptive. Why? Because AI capital spending has become a major driver of United States economic growth. In the first quarter of 2026, by some analyses, it accounted for the majority, and in certain estimates, well over half, of all US GDP growth. That's not a tech sector story anymore. That's the entire American economy leaning on one industry's momentum. And there's one more difference that makes this potentially more dangerous than the pure .com era. Back then, the boom was funded mostly by investors buying stock, real equity. Today's AI expansion increasingly runs on debt, which means if growth expectations collapse, the failures could cascade through banks, insurers, and private credit in a way the .com bust never did. Big tech does still sit on hundreds of billions in real cash reserves. That part genuinely helps. But make no mistake, this is not a clean repeat of 2000. It's something a little more dangerous. Late last year, OpenAI's own CFO floated the idea of a federal backstop, a government guarantee that would help finance all of this. Translation: if the business model collapses, taxpayers could end up footing part of the bill. To be fair, the backlash was instant. Within 24 hours, she walked the comment back, and OpenAI's CEO publicly said the company does not want or need a government bailout. But the fact that the idea got said out loud at all tells you something about how nervous people inside these companies already are. So will this collapse like 2008? Probably not exactly. There's no web of toxic derivatives here, and the balance sheets of the biggest players are stronger. It looks a lot more like the .com crash of 2000. Back then, 90% of internet startups went bankrupt. Trillions evaporated from the market. But the internet itself didn't die. The strongest survived: Amazon, Apple. AI will likely follow a similar pattern. The junk and the overhyped startups get washed away. What survives is whatever actually works, with a real functioning business behind it. Artificial intelligence isn't going anywhere, but we're standing at the edge of a massive financial reckoning. Whether the market clears out the weak players and leaves behind a genuinely useful technology, or drags a much bigger chunk of the economy down with it, depends entirely on how this bubble pops. So, what do you think? Does this crash in the next 2 years, or do these companies actually pull it off? Tell me in the comments. I read every single one. If this breakdown helped you actually understand what's going on, hit like, subscribe. This channel is all about what's really driving our future. Stay sharp. See you in the next one.